Okay, so this is how to actually invest like Warren Buffett, part two. Part one, we went through the four filters, how Buffett thinks about investments and how to identify a quality investment. Hold on a second. That's better. All right. So we got to number four, price. All right. So you stuck in within your circle of competence. You found something that you're capable of understanding. You determined that it had a sustainable competitive advantage. You determined that the management was of high quality. Now you need to know whether or not the current price is a good one, or maybe you're looking at a company that's not publicly traded and you don't have the market to tell you what they think about the price. You have to determine what a good price is for yourself based on actual business figures and not a stock chart. So it all boils down to a company's value is a function of its future cash flows. If it was a bond, bonds you have a coupon. Right now, if you buy a 10-year treasury bond, it's going to yield you somewhere around 3%. You know exactly what you're going to get. You're going to get 3% every year for 10 years, and at the end of the 10 years, you'll get your money back. So bond prices don't move a lot because we pretty much know what they're worth because we can predict the future. With stocks, there's going to be a future cash flows from the business, but it's up to the investor to accurately predict what those future cash flows will be. So in a nutshell, how profitable is the company going to be? Is it going to be more profitable than the current market price would suggest? If so, you might have a winner, but how do we determine? Okay, this is how you figure out what a company should be worth based on its cash flows. It's called a discounted cash flow analysis. And you might have heard of this, but the academics have one way of doing it and Buffett has another way of doing it. One hint I can give you off the bat is that he said, look, we use a fingers and toes approach. We don't calculate things to the nearest decimal place. If a large man comes walking down the aisle, I don't have to put him on a scale to know that he's heavy. It's got to be obvious. If it's so close that you need to count to the nearest decimal to see if it's a good investment, just pass it up and move on to the next one. We're looking for home runs here, okay? Which is why these opportunities don't come along every day, every month, or even every year. So it takes a lot of patience to find something that's in your wheelhouse and is underpriced. So how do we know if it's underpriced? Here we go. First of all, we have to estimate the future cash flow. So let's say this business, I'm gonna invest $10,000. So cash flow number one is negative $10,000. And then I say, okay, but this business is going to make profits, and as a part owner of the business, I get my portion of those profits. So let's say, I'm just gonna let's just pretend that we're buying 100% of a business. Make it easy. Stocks are just pieces of businesses, so all you do is you pretend like you're buying the whole business, and then you buy whatever proportion of it you can afford or want to commit. So the first cash flow is negative 10,000, and I say, all right, next following year, year number one, this is year zero. Well, I can't put zero in Excel. This is year zero. Year one, the company is going to make me $500 in profit. Year two is going to be $600 in profit. Year three, it'll be $800 in profit. Then $1,000, then $1,200, then $1,500, then $2,500, then $5,000. Let's do $3,000, then $5,000. Okay, so these are going to be our cash flows that we're going to analyze. So how much money would you pay for such cash flows? Okay. First of all, we have to acknowledge that receiving $5,000 10 years from now is not the same as receiving $5,000 now. Because number one, if you receive $5,000 now, you can invest it and grow it. Number two, things are going to be more expensive 10 years from now than they are today. So that $5,000 actually isn't worth what we currently conceive of as $5,000. But look, first we can sum up all the future cash flows. See what will our position be at the end. We'll have $4,615 in the bank at the end. Well, I should say we'll have plus our $10,000 back, so we'll have $14,615. But again, we have to discount all these cash flows. So this will be, oh, and let's talk about discount rate real quick. If you have questions about this, just comment and I'll respond. But for now, I'll just tell you that what Buffett uses for his discount rate is whatever the current rate is on a 10-year treasury, which right now is about 2.75%. I'm going to go actually just with a 2% discount rate, just to make things easier. So we got to multiply every number by 0.98, and this is happening in year 10, so we got to do it to the 10th. Let me put an equal sign. All right, so right now, 10 years from now, $5,000 is actually worth 81% of $5,000. So that future cash flow is currently worth $4,000. So we're going to go ahead and do that for all these cash flows. If you're bored, fast forward. I'm just going to go through it and do 9 to the 9th. Jeez. 0.98 to the 8th. There's almost definitely a quicker way of doing this, but I'm showing you longhand because I really want to illustrate what it is we're doing here. Actually, we need to add a line. I'm just going to go ahead and call it 300. Doesn't really matter. Okay. Okay. Now hopefully we can drag this and get a consistent. Oh yeah, check it out. Okay. Oh, this is supposed to be 1500. Okay, so the present value of these future cash flows is equal to the sum of these discounted cash flows. All right, $14,000. So, and actually, let's just do this. Forget about the initial price. That was a mistake to include. Okay, so $14,000 is the current value of these future cash flows. We call it the net present value. And that's present value. So here's the question. Let's say I want to get a 10% return on my money. The market average is 9.6%, so I need more than that if I'm going to do anything besides just buy the index. All right, so I need a 10% return, and I want to know how much money I would pay. How much would I pay today for this future stream of cash flows, such that in the end my return equals 10%. Okay, so imagine I'm investing. How much would I have to pay today, X, for a 10% return, so 1.1, and it's a 10-year period, so to the 10th would equal 14,059. Now we have to solve for X. The way I do this, there's probably a better way in Excel. I know. But the way I do this is I go to Wolfram Alpha. Check it. Wolfram Alpha is an awesome resource. So I'm just going to plug that in here, and it's going to tell me X. So X equals $5,420. So if I'm correct about these future cash flows of this business, and I pay $4,520. I pay $4,520 now. I wait 10 years. At the end of it, I have $14,059, or well, that's the net present value, and I have an adjusted for inflation return of 10%. All right. that's it in a nutshell. I wanted to keep this video to 10 minutes. Here we are, 10 minutes. If you have questions, please comment. I might even do another video because I really want you guys to understand this stuff. All right, happy investing.